Income taxes 101. Why are business income taxes so complicated? Well, let's dive in. We're going to look at it from three different aspects. First, we're going to compare it to when you were an employee and how easy it was from that standpoint, and then also from the business entity and you as the business owner. So let's go back to when you were an employee. Income taxes were a lot easier because your employer calculated how much you should pay based on the dependents that you claimed on your IRS form. They withheld it from your paycheck, and so everything was taken care of before you actually received the deposit. And so that limited the surprises when it became tax time. All of that money was submitted to the IRS, and then at the end of the year, you really were just reconciling, saying, hey, this is how much I made, this is how much I owed, I've already paid, and there's a little bit that is either a refund or maybe you owe just a little bit. But it was a really simple life from an income tax standpoint, because when you looked at your pay stub, you knew when you received that deposit, that net pay, in this example of $745, you knew that all of that money was yours to spend. When that money hit your bank account, you knew that you could use that for groceries, gas, rent, anything you wanted to use it for, because the IRS and the state were all taken care of from an income tax standpoint. But then you started your business and it started to get a little bit more complicated, because it turns out that most businesses don't actually pay income taxes directly to the IRS or to the state, because most businesses are considered to be pass-through entities. That means that the net income passes through to the owner. So here is a quick comparison table. If you are a C corporation, then your company actually pays income tax to the IRS. But the other four categories, S corporation, LLC, general partnership, and sole proprietor, all four of those are considered to be pass-through entities. The net income passes through to your owner tax return, and that's where all the magic happens with the calculation. And so here's an example. Let's say that this is what your profit and loss statement looks like. Go all the way down to the bottom. You've got net income of $30,000. That $30,000 passes through to your tax return. So it's possible, depending on your tax bracket, but let's say that between the federal tax and your state tax, both of those rates add up to 33%. Your net income of $30,000 is going to increase your tax liability of $9,900. This is where it starts to get complicated. As a business owner, you've got to manage your cash flow very, very well, because the money that's in your bank does not necessarily mean that that's money that you can spend. Your customers are paying the full sales price, but you still need to pay your employees and your vendors, suppliers, insurance, overhead, all of those type of expenses. So you actually have to manage that cash flow. Plus you've got to hire someone to prepare accurate financial reports. You're never going to be able to know how much you need to pay in taxes if you do not have an accurate profit and loss statement that shows you what that bottom line number is going to be and what's going to be passed through to your personal tax return. On top of all that, you've got to pay estimated tax payments. That's where tax planning with your tax accountant can come in handy, so that way you're not having to pay one big lump sum at the end of the year. You can actually break that up into quarterly estimated tax payments. Then you want your business checking account to actually have cash reserves where it can distribute, pass through the cash that you need to pay for the taxes. It should never fall on a burden for you as the owner to pay those extra taxes out of your personal savings. The business is passing through the net income. It should also be passing through the cash so you can easily pay your taxes on time. So here is a quick recap. As an employee, it was pretty much taken care of for you because you had the paycheck deposited after the taxes, after everything was taken care of. As a business, your customer is paying you before taxes are even considered. So it creates a cash flow, money management type of system that you need to have in place for your business. And then the owner needs to pay the estimated tax payments on a quarterly basis, so that way you prevent having to pay any late payment penalties. Thank you so much for watching. As always, you know what to do. Please help me spread the word so we can help other business owners better understand their business finances.